Hi, this is JC Parets with AllStarCharts.com, and I'd like to welcome you to what I think are the most important 50 charts in the world. In honor of Super Bowl 50 this past Sunday, we created a countdown to run these charts from 50 to what I think is the most important chart in the world. Um, some of these are more actionable than others, but I think collectively they really tell a true story as far as what's happening globally, as far as risk appetite is concerned, and for that matter, risk aversion, as we'll see in many cases. To make my attorneys happy, as you guys know, none of this that we're going to discuss today is any sort of solicitation or recommendation to buy any securities. Before you do anything, please consult your investment advisor to make sure you're suitable to do some of the things that we discuss here. I know that you guys know this already, but I'd just like to reiterate that everything we discuss here is for educational purposes, informational purposes, and entertainment purposes as well. So let's rock and roll. We'll start with chart number 50. I think Facebook is a stock that I think it would be disingenuous for me not to include it in the list because I get asked about it so much. It's such a widely held name. It's now one of the largest companies in the world, believe it or not. So let's discuss exactly how to take advantage of future price movements in Facebook. As we can see here, last summer, we achieved the 261.8% extension of the initial correction after the IPO. If you recall, it dropped down under 20 immediately after it went public and then exploded after that, and the rest, they say, is history. So as soon as we achieved that upside objective, we've been those gains, in a rising wedge pattern. When we see consolidations of tremendous upside, which we obviously have here, we want to see that consolidation counter trend or at least sideways. When we see it in the direction of the underlying trend, oftentimes that means that a reversal is taking place. So how to take advantage of this moving forward? If we break last month's lows, $89.50, we want to be short of Facebook. That would confirm exactly what we're describing here in this rising wedge and would confirm a bearish momentum divergence. So again, we only want to be short Facebook if we are below 89.50. Buy Canada, short America. This is an important stock because Canada and other commodity-based economies have been serial underperformers for many years, particularly against the S&P 500 and the United States stock market. And I think that this is changing. As we can see here, this is the Canadian stock index versus the United States. And we broke in the fourth quarter below the lower of these two parallel trend lines and quickly reverse course. So from failed moves come fast moves in the opposite direction. We've already started to see that, and I believe that this has confirmed the bullish momentum divergence. We want to be long of Canada and equivalently short of the S&P 500 as long as we are above the lower of these two parallel trend lines. So I think an inversion of the yield curve is coming. You guys that follow me for a long time know that this is nothing new. I've been talking about this for some time. We expected that a break of 1.2 was coming eventually. Let me just rewind a second. This is the United States Treasury bond yield, the 10-year yield, minus the United States Treasury bond 2-year yield. So 10s minus 2s. And as we're seeing, that curve is flattening. During traditional times, the government pays us a higher interest rate for longer dated bonds. And I mean, that just makes sense. So 20s and 30s are going to pay you a higher yield than 2s and 5s and 10s. That's a traditional steepening yield curve. That's normal. However, that's been narrowing for years, and I believe that it continues to narrow as the short end, continues really to to collapse relative to the long end. So we want to continue to play the spread, this narrowing of the curve, and I believe that we're heading down towards those 2006 lows, and we want to be short 10s minus 2s as long as we are below 1.20, which has been support since 2008, and I believe an inversion of the yield curve is the next stop. So the next chart is, why we want to be shorting Warren Buffett very aggressively. It's not a secret that, Berkshire Hathaway is a serial underperformer, has been underperforming the market over the last year. underperforming the S&P 500 also over the last 5 years. During when the market corrects and has big drawdowns, Berkshire Hathaway is not any safe haven at all. In fact, when the market comes down, Berkshire Hathaway traditionally does even worse. In 2008, Berkshire Hathaway had a 60% drawdown. Again, a serial underperformer that we want to be shorting aggressively on any and all strength. This is a broken stock. And as long as we're below the downtrend line from last year's highs, we want to be shorting Warren Buffett and Berkshire Hathaway aggressively. And, with every loser, there's a winner. And, when money comes out of one market, it's going into another. And this is something that, this is the theme that we're going to be discussing through this short video. And that's money flowing into utilities. Really, in my opinion, because of its high dividend paying nature, this is the Dow Jones utility average versus the Dow Jones industrial average. So in other words, utility stocks versus everybody else. And, this has been a serial underperformer for years, and I believe this is now changing. We are breaking out to new highs on a relative basis, and this is a massive bottoming pattern. This is a massive accumulation of assets in the utility space, and I think that on any dips, we want to be buying utilities, particularly relative to the rest of the market. Chart number 45 is European banks are actually somehow worse than U.S. banks. We'll get into it in a minute, but U.S. financials are, speaking of serial underperformers, I've been in a downtrend for years already. So the fact that European banks are even worse really speaks volumes as to, how bad things really are out there. So this is the Dow Jones Europe Financials Index relative to the Dow Jones U.S. Financials Index. And as it's declining, that means U.S. is doing better than Europe in terms of the financial sector. And that really speaks volumes. Once we broke last year, we retested that key uptrend line that broke in the summer, and we want to be shorting any strength in this particular ratio and fully expect European financials to continue to underperform U.S. banks. Chart number 44 is a goodie, an oldie but a goodie. You guys that have been following me for a while know that I've been pointing to this chart, really since the beginning of 2015, as prices were getting close to that level. We're looking at a 20-year chart of the NASDAQ composite running into the March 2000 highs and immediately reversing. And this is what had me worried, really, coming into the, since last summer in terms of the market. And the counter argument is, listen, JC, I get it. That's what the chart says. But the NASDAQ today is not comparable to the NASDAQ back in 2000. They're completely different markets. They're different components, and you simply cannot compare them. And that may or may not be true, but the market clearly respects those former highs. It took 15 years to get back up to that level. We had a massive run, particularly from the 2009 lows, and immediately stopped at the March 2000 highs. So whether or not it's a different market is really irrelevant as far as this conversation goes and as far as execution goes. The market clearly cares, and we want to be selling into any and all strength and continuing to short the NASDAQ composite as we roll over from those 2000 highs. This is a beautiful one, guys. This is chart number 43, a bearish to bullish reversal in the euro. This is euro USD, so the euro relative to US dollars. And this is just a massive bottoming pattern. A year ago, all you heard in the media was how important the euro is, how it meant everything, how it was the most important thing to talk about, and they really exhausted that. And then it's funny, the euro has done nothing over the past year as it's been consolidating those declines, and you never hear anybody talk about the euro anymore. To me, that's just further evidence that news follows price, not the other way around. So to follow the news is really irrelevant because the news, the quote unquote news, is just justification of price movement. So if we follow actual price behavior, we don't have to worry about the news. And I think this is just a great example. I have a funny feeling that in the next couple of months, you're going to be hearing an awful lot about the euro because, as usual, news follows price. And I think that the euro continues higher. You guys that have been following me and members of All Star Charts know we've wanted to be long of euro as long as we were above 108. We are obviously above that. We remain above that, and we want to be buyers of any weakness in euro as we expect this to continue higher. Rare earth metals is something, speaking of never getting mentioned, there are some of you that are watching this out there that have been around the market for a long time. And, there are some of you that are new to this market. But I could just tell you that back in 2009, 2010, rare earth metals were all the craze. I mean, these were the momentum stocks. Everybody wanted to be involved. This was the sexy story of the time. And then some genius decided to create an exchange traded fund, an ETF of rare earth metals, and they've done nothing but crash ever since. So from a comedic standpoint, it is pretty humorous. But truthfully, over the last year and a half or so, prices, this more recent leg lower has come in a very classic, falling wedge pattern with converging trend lines, very well defined, and with a bullish momentum divergence at the recent lows last month. We want to be buyers of a breakout above the upper of these two converging trend lines and only be long of rare earth metals if we are above the upper of these two converging trend lines. I think that this could potentially be a great trade if that does indeed occur. And from a risk reward standpoint, I believe it very much favors the bulls. So here we're looking at why gold is now a better investment in the U.S. stock market. And I think it's very simple. Really, since the bottom in 2011, U.S. stocks have been a major outperformer as, obviously U.S. stocks have, are going on to hit all-time highs in terms of the Dow Industrials and the S&P 500. And gold has been in a 5-year bear market. Not really a secret. This has just been a disaster. Precious metals have been crashing for 5 years. And I think this is now changing. We already broke the uptrend line in this particular ratio from the 2012 lows, and I think we're on our way to break the uptrend line from the 2011 lows. So this is the Dow Jones Industrial Average relative to gold, and I believe this is now broken as that 200-day moving average is now rolling over. We want to be sellers of any and all strength in U.S. stocks, particularly relative to gold. So for every dollar that we are long of gold, we are short $1 of the Dow Jones Industrial Average. And this spread is something we want to be selling into on any strength. This is an important theme, guys, and one that I'm not hearing much about these days in terms of people talking about it. A lot of people for a long time just assumed that small caps outperform large caps. I mean, that's just been instilled in our head for a long time. But over the past decade, we've just seen a massive, massive distribution pattern taking place. We have a bearish momentum divergence at the more recent highs of the last couple of years. And this is just massive distribution. I think that we're heading a lot lower. And I think from here on in, large caps are going to be outperforming small caps. And this is something that we need to get accustomed to. So we're looking at the Russell 2000 small cap index relative to the Russell 1000, which represents larger cap stocks. And I believe this trend is over and we're heading lower. So we want to be selling any and all strength in this ratio and fully expect large caps to outperform. Getting back to the one of the first charts that we look at, utilities, and how we were breaking out relative to the Dow Jones Industrial Average, this really tells the same story. But it's not just utilities, it's stocks that pay dividends as a group. Here we're looking at the Vanguard Dividend Appreciation Fund relative to the S&P 500, breaking out above a multi-year downtrend channel. This is a major shift in trend, a major shift in sentiment, a major shift in money flow. We have a bullish momentum divergence at the fourth quarter lows. You can't draw it up any better than this. This is suggesting we want to own stocks that pay dividends, short everything else, and we want to be buying any dips in this particular ratio. The next chart is what I think is really the key to the whole thing, guys. This is the dollar yen. 122 is the big level. Look at this. This is in 2007. Look at the failed breakout in 2007, right before the overall U.S. stock market peaked and then crashed. And USDJPY crashed along with the U.S. stock market. And here we are back again, back at those levels in an eerily similar failed breakout. And man, I got to tell you, as long as the dollar yen is below 122, bad things will happen to the U.S. stock market. Volatility will spike or continue to spike. 122 is the big level. If we happen to get back above 122 and stay above 122, I think that would be very, very constructive for risk assets, particularly U.S. and Japanese stocks. But I think that's the lower probability scenario. I think dollar yen continues its collapse, and as money goes into yen, it's coming out of risk assets like stocks. So I think this is heading lower. I think gold miners are where we need to be, guys. You guys know that follow me. We wanted to be buying this a few weeks ago, down at $13. This is GDX, the Gold Miners Index. I believe it was a beautiful, failed breakdown. You could see it right here a couple of weeks ago. And from failed moves come fast moves in the opposite direction. We're going to show you guys some similar examples to that on both failed breakouts and failed breakdowns in a minute. But in this case, I think short term, sure, we were right. That's great. Great trade. We wanted to be taking profits, as long as we were above, once we got above 15.5. But bigger picture, this is a weekly time frame, so we're looking at it from a much more structural standpoint. I think this is a massive failed breakdown below the 2008 lows, and we want to be buying gold miners very aggressively. As long as we were above the 2008 lows, we want to be buying gold miners very aggressively. I think this is a monster trend that just got started and can potentially double from here. Chart number 36 is the Dow Jones Composite Average, right? Which is suggesting we need to short everything. The Dow Jones Composite Average, for you guys that don't know, is a combination of all three of the Dow Jones indexes. This is the Dow Jones Industrial Average, which has 30 stocks, the Dow Jones Transportation Average, which has 20 stocks, and the Dow Jones Utility Average, which has 15 stocks. So the Dow Jones Composite Average consists of all 65 of those stocks. And, as we approach the upper of these two converging trend lines, we broke out and failed miserably. And that failed breakout, I think, is going to lead to further downside. It confirmed the bearish momentum divergence, and we want to be selling any and all strength in the Dow Jones Composite Average, which suggests that overall stocks are going lower. Listen, guys, biotechnology has been one of my favorite shorts since last summer. People laughed at me and even got mad at me that I would even suggest that, quote unquote, America's strongest sector was heading lower. Here we are getting absolutely destroyed. So there's a comedic aspect to it as well. But listen, this has been a great short for a long time, and I think it's going to continue to be. Here in particular, we're looking at the biotechnology sector relative to the rest of the market. And we broke the 2014, the uptrend line from the 2014 lows. That broke last summer. We retested it 3 times, failed beautifully, and rolled over once again. So, guys, this is a bear market in biotechnology. There's absolutely no doubt about it. And we want to be selling any and all strength in biotechs, particularly relative to the rest of the market. This is a downtrend. Another big theme that I think is important to discuss, and why I included it in this list, is growth stocks versus value stocks. I mean, growth has been the big winner really over the last decade. I mean, there's no doubt about it. Growth stocks have been outperforming value stocks for a long, long time, which is a sign of health in this market, which is a good thing. And I think that this is over, and the trend is now to the downside, where value is now going to be outperforming growth. We reached the upper of these two converging trend lines, nice little bearish momentum divergence, and down we go. Not only do I think we head lower from here, I think we ultimately break the uptrend line from the 2007 lows and head substantially lower. So from here on in, value over growth, guys. Getting back to, things outperforming the market. We talked about gold, gold miners doing well. Here we're talking about oil. I think oil from here on in is going to be a better investment than the U.S. stock market. Here's a ratio of crude oil relative to the S&P 500, and we are now down to the 2000 and 2001 lows. We have a bullish momentum divergence at these lows. So for every dollar that we are long oil, we want to be short $1 of the S&P 500. And this is a trade that we want to have on only if we are above those lows from 2000 and 2001. The next chart is bond yields. It's not just U.S. Interest rates falling, and which is something that we're going to discuss in a minute, but globally, money's coming out of, money's going into bonds, and yields are falling internationally as well. Here, obviously, it was no secret, German bond yields collapsed in 2014, early 2015, just a complete collapse of yields. And then we had a killer bounce to the upside, in the spring, early summer, killer bounce. So we had a very healthy consolidation since then, getting back to how we want prices, or in this case, rates, to consolidate gains counter trend, or at least sideways. So this is a textbook continuation pattern in yields. However, a traditional bullish continuation pattern resolve to the downside. And when traditional bullish continuation patterns resolve negatively, the market is speaking. The market is telling us that there are larger forces at work, and this is a big problem. So going forward, we fully expect yields in Germany to continue to fall, and we want to be buyers of any and all dips in the German Bund. There's an ETF BUND Bund where you can, which will help express this particular trade. Speaking of serial underperformers, Bank of America, has been one of the worst out there. Not a secret. A lot of people out there, feel, they're very emotional when it comes to Bank of America. I don't know why. Maybe it's because it's Bank of America and they feel patriotic by owning this or standing behind it. But I just think that's a foolish strategy. Who cares? We treat it as anything else. It's just letters and math, guys. So there's no reason to get emotional over a name like this. We've been in a sideways range for several years while the S&P 500 explodes to all-time highs. Bank of America's gone nowhere. And that can be seen in the plot below where you see Bank of America relative to the S&P 500 in a multi-year downtrend. And simultaneously last month, we broke in price below the lower end of the channel, and we broke relative to the S&P 500. So as bad as Bank of America has been over the last several years, it is now worse. And we want to be sellers of any and all strength in Bank of America, shorting into strength, particularly relative to the rest of the market. This is an underperformer. It's been underperforming, and it certainly appears as though this underperformance will continue. So here we're looking at the Wilshire 5000, which gives us a much more global perspective on stocks. And I see here a broken trend and a massive distribution taking place over the last couple of years and being completed. The 200-day moving average is now rolling over. We want to be selling any and all strength in the Wilshire 5000 as we fully expect much, much lower prices in global equities. Chart number 29 is Apple's downtrend. This has been one of my favorite shorts for a long time. We said, last summer that if we broke the range that it had been in since February, we wanted to short it, and that's exactly what occurred in summer. And we wanted to be shorting any and all strength in Apple ever since last summer, and this has not changed. This isn't a bear market. There's no doubt about it. Apple's in a downtrend. It's a very beautiful downtrend, very clean. Momentum is in a bearish range, and nothing has changed. In fact, everything that we're seeing has confirmed everything that we were seeing last summer. So again, in Apple, this continues to be a great short, and any strength towards the upper end of this range, I think we can use as an opportunity to get short once again. So consumer discretionaries relative to consumer staples is a very important ratio because it really represents what institutions are doing. A lot of money out there is run by long-only fund managers that are benchmarked against the S&P 500 or one of the major large-cap indexes like the Dow Industrials. And when you see a ratio of consumer discretionaries relative to consumer staples, it tells us what the institutional money is doing, because these guys, their mandate is they need to be almost 100% allocated at all times. That's their mandate. They can't get short because they're long only. So the way that they get their raises and their bonuses and the way they increase their AUM is by outperforming their benchmark, in many cases the S&P 500. So the way that they hedge is by positioning themselves overweight the consumer staples. So things that we're going to be buying regardless of economic conditions. So cigarettes and beer and Coca-Cola and, dishwasher detergent and, things that regardless of economic conditions, we're going to be buying. So if a fund manager thinks that the market is going lower and thinks that it needs to be defensive, it's going to flow money much faster into staples as opposed to consumer discretionaries, which us as consumers, by definition, where us as consumers spend our discretionary income, automobiles, home builders, retailers. These are the consumer discretionary stocks. And, if a fund manager wants to be aggressive and wants to outperform a rising stock market, it needs to overweight the more speculative consumer discretionary space. So the ratio between the two really speaks volumes. And we had a beautiful failed breakout in the fourth quarter last year. From failed moves come fast moves in the opposite direction. This confirmed the bearish momentum divergence, and down we go. Momentum's in a bearish range now, and I believe we are heading down towards 131 in the spread between discretionaries versus staples, XLY, XLP. And I think we're going to the 38.2% Fibonacci retracement of the entire 2008 to 2015 rally. I think that's the next stop. And we want to be selling into any and all strength in this ratio. Guys, this is, continuing with this theme of discretionaries and staples. I think that it just makes sense to talk about the internals of the market. Here we're looking at the list of new 52-week lows on the New York Stock Exchange. And last month, more new lows were made on the New York Stock Exchange. More 52-week lows were made than they were in August, right? So this is telling us that the overall market is now weaker. So yes, the indexes made new lows, but so did the components, which is what's important. If you for a market to bottom out, the components themselves that make up those market indexes need to stop making new lows. So if you're bullish this market and you think or you want the market to go up, what you want to see is fewer and fewer new lows on the New York Stock Exchange as the indexes themselves make new lows. That tells us that the internals, the market of stocks, if you will, are bottoming out. And not only are we not seeing that, we're seeing the opposite. We're seeing new lows on the indexes, and we're seeing new lows in terms of the components themselves. So until that changes, this is still a bear market. And chart number 26 here, before we hit the halfway mark, is the internet stocks compared to the rest of the market. And this has been a monster winner. The internet stocks have really been the outperformers. There's no doubt about it. It's not a secret. It's been very well publicized. I think that's over. We had a beautiful failed breakout in the fourth quarter last year. That failed and confirmed the bearish momentum divergence at the more recent highs, and that became the catalyst to break the uptrend line from the 2008 lows. So I think that this trend is here to stay, and we want to be shorting internet stocks. These are the Amazons, Facebooks, Googles, the Netflixes of the world. The internet stocks out there relative to the rest of the market is now a short. We want to be shorting any and all strength, particularly relative to the rest of the market. And now I think we're halfway through, so it's a good time. I want to show you guys, we started a premium membership at All Star Charts in the fourth quarter last year, and really got things going big time in 2016, added a lot of new features. Let me just tell you what we're getting, and I'm going to give you guys a huge discount, in honor of Super Bowl 50. First of all, you're getting a weekly multi-page letter. This goes out at the beginning of every week, 4 pages, describing everything that's happening globally. We're talking about U.S. stocks, international stocks, individual sectors in the United States. We're talking about the commodities market, what's happening in oil, gold. Is the agricultural commodities a place that we want to be in? Corn and soybeans and sugar and cotton, coffee. It's not just about gold and silver and oil. And although we do touch on those, if there's a trend elsewhere in the commodity or the currency space, we're going to talk about it. We've liked euro for a while. That's been working. We've wanted to be shorting the US dollar. That's been working. So we talk about all of the ongoing themes and then changes in trends that we're seeing there in the weekly multi-page letter. I think it adds a lot of value. Also, we have a monthly conference call. This week's conference call is on Thursday. In fact, it's usually after the first week of every month. And we get all of our members. This is a community. We're all in this together. And the monthly conference call is an opportunity for me to show you guys what I think are important themes and trends that I want to make sure we get across during the call. And then always we try to save as much time as possible to answer the questions from you guys. Because again, this is a community. We're all in this together. We're a team. So I think the Q&A really adds a lot of value, not just to the members, but to me as well, to get a better understanding as to what you guys want. In my opinion, the chart book is a new feature that we have this year that I think is a great feature. There's over 300 charts that are annotated weekly or bi-weekly, depending on which particular type of chart that we are looking at. All of the S&P sectors and subsectors, notice how they're all on weekly and daily time frames. What this does is that it shows us exactly, for example, we can look at consumer discretionaries, for example. We're looking at it on a weekly time frame to get a much more structural perspective. There is comments on every single chart. And we look at everything on a daily perspective as too. So the weekly charts are there to get a structural view, get a big picture outlook, and then the daily charts are more for tactical and execution purposes. So we have all of the S&P sectors and subsectors, all of the global markets, go through all of these countries, all of their indexes and or ETFs. I find the value in all 30 Dow components to get a good understanding as to what's happening within the Dow Jones Industrial Average. Also, obviously, all of the major U.S. averages and interest rates, not just the S&P 500, but the Russell 2000 small cap, the mid caps, the micro caps, and what's happening in interest rates as well. And then one of my favorites is the intermarket analysis, where we're comparing one market to another. We find a lot of value there in terms of where money is flowing, not to mention all of the sectors relative to the S&P 500. How are financials doing compared to the market? How is energy doing? Healthcare, etc. More recently, telecom and utilities are breaking out. Financials are breaking down, for example. So these charts really give great perspective in that respect. And then obviously all of the commodities. You got your precious metals, your energy, your ags, and all of the major currency crosses. Not just from an execution standpoint, where we want to be buying euro versus the dollar, but also from a risk-on, risk-off standpoint. What's happening in the currency market tells us a lot about what's happening in the overall stock market globally. There's a members-only forum where community members can chat and share ideas as well, and I'm in there sharing ideas myself. And what I think is a great value is the 24/7 access to myself. If you have any questions on anything that I'm writing about or sharing with you guys, or any particular questions on your own portfolio or a trade that you have on, there's a messaging service where you can access me at any time you'd like. And then listen, guys, we're giving you a 30-day risk-free trial. There's no reason not to try it out. I think there's a lot of value there. And if for some reason you don't think it's for you, that's fine. We'll give you your money back, no questions asked. We're offering a huge discount, $297 for the quarter with this particular discount deal, and $997 for the entire year. And you guys can sign up at allstarcharts.com/SuperBowl. This is a limited time offer only, and I think that this is a deep discount. Guys, think about it right now, how much you've lost in a given trade, in a single trade recently, and think of taking that money and reinvesting it in yourself. And like I said, it's a 30-day risk-free trial. So if it's not for you, and I'll tell you right now, it's not for everybody, but if you feel it's not for you and it's not adding any value, we'll give you your money back. So again, allstarcharts.com/SuperBowl. So here's the top 25 charts in the world right now, in my opinion, and I think natural gas is one that is very widely followed, and you guys ask me about this constantly. So what is the answer? Is it's going to take some time. What does natural gas need to bottom? And I think answer number one is time. Bottoms are a process, and we're not quite there yet. Sure, we had a lower lows in October and December, followed by a higher low more recently, and this could be the start of a bottom in natural gas. But not only is it going to take a little bit more time, we need to break out and confirm this above that neckline, which we have not done. So we want to be buyers of natural gas if we're above 240. That's the trade. So I think it's going to take a little bit more time. Here's, I think, a very important trend that I'm not hearing a lot of people talking about, and it's in Latin America. Latin America has been a serial underperformer for many, many years, not just on its own, but within the emerging market space. I mean, think about how bad emerging markets have been over the last several years, and somehow Latin America has figured out a way to be even worse. So as this trend has fallen, that's emerging markets outperforming Latin America, but I think this is now changing. Notice how prices in this ratio over the last few weeks got down to the former resistance levels in 2002, 2003, 2004. And I think that this is a logical place for this ratio to bottom and mean revert. So as long as we are above the December lows in this ratio, the Latin America 40 index relative to the MSCI Emerging Markets Index, as long as we're above the December lows, we want to be aggressively long this spread. For every $1 long Latin America, we want to be short $1 of emerging markets. Chart number 23 is really one of my favorites out there. I've been very vocal about it for many months, talking about how Treasury bonds are going to outperform the S&P 500, or for that matter, continue to outperform the S&P 500 as they have for the last couple of years. Notice how this spread between Treasury bonds versus stocks bottomed out at exactly the 2007 lows. Guys, this is not a coincidence. I think that this shift in trend is a major shift in trend, and I think it's here to stay. So we want to be buyers of any dips in the ratio between bonds to stocks. You know, Indian stocks are not immune to the selling that we're seeing in the United States. Here we're looking at the Nifty 50 in India, achieved our price objective, which was near 8250, which was the 161.8% Fibonacci extension of the entire 2008 decline. We reached that, tried to get above it, failed, and down we went. And that failed breakout and bearish momentum divergence became the catalyst to send prices tumbling to break the uptrend line from the 2009 lows. And I think we're heading lower. We want to be sellers of any and all strength in the Nifty 50. And I think we're heading down towards 6,500. This represents the 38.2% retracement of the 09 to 2015 rally. I think that's where we're headed and where we want to cover shorts. You know, when we talk about the internet stocks underperforming, a few minutes ago, momentum stocks, a lot of these momentum stocks are internet stocks, but they're not. It's bigger than the internet stocks because the momentum index consists of things like McDonald's and Visa and Home Depot. So it's not just the internet stocks, guys. It's momentum in general. Here we're looking at the momentum index relative to the S&P 500. Beautiful failed breakout last month above last year's highs. Failed miserably, bearish momentum divergence. This trend is over, and I think it's heading a lot lower. Guys, from failed moves come fast moves in the opposite direction. I think this is going a lot lower, and we want to be selling into any and all strength in momentum, particularly relative to the overall market. Chart number 20 is really one of my favorites. It's the S&P 500 meeting Mr. Leonardo Fibonacci. Here we're looking at a weekly time frame of the S&P 500 running into the 161.8% extension of the 07 to 2009 decline. And, you guys that follow me for a long time know that I was pointing to this chart, well over a year ago, as well before prices even hit this objective. This was one of the reasons that I was worried structurally in terms of the market and why there's been no reason to be long the S&P 500 from any sort of structural standpoint, maybe for a trade, a counter trend trade, sure. But structurally, this is going lower. We want to be sellers of any and all strength in the S&P 500, and I think we're heading down under 1,600, which were the 2007 highs. I think we retest that. So, I know a lot of people, for whatever reason, don't follow Fibonacci. They don't calculate the extensions and retracements. I, quite frankly, have no idea why. The market obviously respects these levels, so I think it would be irresponsible of us not to. Chart number 19 is the German DAX. Guys, it's not just U.S. stocks selling off. They're selling off globally, and I think the German index is a very good example of that. After a monster run since 2011, prices have consolidated over the last 15 months or so, and this consolidation has now resolved to the downside. So I think we're heading a lot lower, and we want to be sellers of any and all strength in the German DAX. Getting back to the interest rate market, here is the shorter end of the curve. This is the United States Treasury bond 1-year yield. And as you can see, we had a beautiful uptrend channel over the last couple of years. We had a failed breakout last year in the fourth quarter, and that became the catalyst to send yields tumbling. And, more reason why we want to be buyers of bonds on any dips. I think yields are going lower, and I think that they're heading down under 30 basis points. I think that's where we're headed at best, and likely even lower than that. And it's not just here in the United States, guys, it's globally. So here we're looking at the 10-year yield in Japan, Germany, United Kingdom, and here in the United States. In green, we see the Japanese interest rates getting destroyed, along with the German interest rates in blue getting destroyed. So up top in red and in pink, we have the U.S. and the UK, and I think that they're going to play catch up or catch down for that matter. And U.S. interest rates and interest rates in the UK will come down substantially from here to catch up to Japan and Germany. Now, getting back to Latin America, guys, when we're talking about Latin America outperforming going forward, I think Brazil's a great example. Here we have a downtrend channel from the past several years, and we broke down to start the year below the lower of these two parallel trend lines, and I think this potentially could be a catalyst to send Brazilian stocks higher, a failed breakout, a failed breakdown. So we want to be buyers aggressively of Brazilian stocks as long as we are above the lower of these two parallel trend lines. Getting back to U.S. interest rates, here's chart number 15 on the list. And again, these are the 2-year yields. So we looked at the 1-year yields, had a nice failed breakout and are rolling over hard. Now we're looking at the 2-year yields. Again, similar, very nice failed breakout above the upper of these two converging uptrend lines, and confirmed the bearish momentum divergence, and down we go. So again, more evidence that we want to be buyers of bonds on any and all dips. I think interest rates not only will in the 2-year yield fall below 55 basis points, but I think ultimately breaks the uptrend line from 2013 and heads under 50 bips. Here, getting back to the commodities market, we're looking at soybean oil futures, and I think that a breakout is imminent. You know, we had a failed breakdown last year in the fourth quarter below the 2008 lows, and I think that can be the catalyst to send futures higher. So, you know, we have a very clean downtrend line from 2012 highs, and we have a bullish momentum divergence at last year's lows. And we want to be aggressive buyers of soybean oil futures as long as we're above the downtrend line from the 2012 highs. And a question that I get asked a lot, guys, has crude oil finally bottomed? I don't know the answer to that, but I will tell you that this 2960 area is a big one. You know, when we talk about Fibonacci and we calculate Fibonacci extensions, when they cluster together, I think that you get more powerful signals and more powerful levels. So I think this 2960 is a big one. This is, you know, when you look at the 161.8 extension of the correction, the rally, the counter trend rally between last March and May, it takes us just under 30. And if you calculate the more recent counter trend rally from August to October, it also takes us just under 30. So that's the level. If we're above those levels, we want to be long. And if we're not, we do not want to be long. So that's how I want to look at crude oil. And ultimately, if we break the downtrend line from the fourth quarter highs, we want to be even more aggressively long. So that's the level. If we're above it, we want to be long. If we're below it, we do not. You know, getting back to technology and failed breakouts in that space, guys, I mean, look at Electronic Arts. It doesn't get cleaner than this. Look at the failed breakout. This is chart number 12, an EA, Electronic Arts, that makes video games above the 2004 highs. From failed moves come fast moves in the opposite direction. That failed breakout became the catalyst to send shares tumbling, breaking the uptrend line from the 2012 lows. And we want to be very aggressive sellers of EA on any and all strength. As long as we're below the uptrend line from the 2012 lows, we want to be shorting EA very aggressively. You know, we talk about interest rates before, not just in the United States, but globally. And the beneficiary of lower rates is the U.S. bond market. There's no doubt about it. And, you know, we've been in a bull market in U.S. Treasury bonds for many, many decades. And a lot of people feel that it's over. But price action suggests otherwise. Not only do I not think the bull market in bonds is over, I think the next leg higher is just getting started. And we want to be aggressive buyers of, this is the 10-year note. We want to be aggressive buyers as long as we're above the downtrend line from those highs in 2012. That's a textbook symmetrical triangle. The risk is very well defined, as we only want to be long above that downtrend line. And we want to be very aggressively long and buying any and all dips. So here we are getting into the top 10. You know, we're looking at European banks on their own. Earlier, we discussed European banks relative to U.S. banks, how terrible they were. And here they are on their own. So here is the Dow Jones Europe Financials Index. There's an ETF as well, EUFN. Edward, Uranium, Frank, Nancy. But here we're looking at the index itself breaking the uptrend line from the 2009 lows. You know, guys, this is a downtrend. There's no doubt about it, and we want to be shorting European banks very aggressively as long as we're below the uptrend line from the 2009 lows. So we're going to get into gold a little bit. You know, gold is really, you know, shifting. We talked about gold miners earlier, and now we're going to talk about the metal itself. Here we're looking at gold relative to copper. So precious metals versus base metals, really. And just look at this massive consolidation over the last 5 years. And now that's resolving to the upside. Huge base to come out of. For every dollar we are long gold, we want to be short $1 of copper. And as long as we're above this downtrend line from the 2011 highs, this is a trade that we want to have on very aggressively. So chart number 8, when you talk about interest rates, we've shown a lot of examples of why we think interest rates are going lower, but we're seeing similar evidence from the stock market. Up top, we are looking at a ratio of regional banks relative to real estate investment trusts. So the regional banks, the market believes that regional banks, the stocks will do well if the stock market, if interest rates are rising and the spread and the yield curve is widening. That's good for regional bank stocks. On the other hand, real estate investment trusts, REITs, who pay higher dividend yields, benefit from lower interest rates because there's money, fixed income money that is not getting their yield in the bond market, has to go to the stock market to get their yield. REITs are a place that they look because of their high dividend paying nature. So the spread between regionals and REITs tells us where the market thinks rates are going. And this trend is lower. And there's no evidence that this is changing. And we're looking at it as a leading indicator. And everything that we're seeing here suggests that interest rates are heading lower. As you can see, the correlation, as this ratio goes, so does the 10-year yield plotted below. And I think that we're heading a lot lower in both. So chart number 7 is gold. Getting back to gold, here's gold relative to the rest of commodities. Really a textbook, head and shoulders continuation pattern over the last 5 or 6 years or so has now resolved to the upside. We have about 2 points based on the measured move from the 2012 highs down to the 2014 lows. That's 2 points from the breakout just above 6. That gives us a measured move target of about 8 to 1. So we want to continue to be buyers of gold relative to the rest of commodities. For every dollar gold that we're long gold, we want to be short $1 of the CRB index or the futures or the equivalent ETF for that matter. So chart number 6 is gold relative to price in Australian dollars. So, a lot of people often look at gold price in US dollars. I think that this chart is very, very clean. Gold priced in Aussie. So as we buy gold, we want to be shorting Aussie against it. I think that this spread is going a lot higher, and we want to continue to be buying gold in Australian dollars as long as we are above the downtrend line from the 2011 highs. So getting into the top 5, guys, I think these are some very important charts, not just from an analytical standpoint, but from an execution purposes as well. Here we're looking at General Motors relative to Tesla. And Tesla's been the big winner in the automotive space for many years. That's not a secret. General Motors is General Motors. But I think that this trend is now changing. Look at this massive bottoming process of the last several years, bullish momentum divergence at last year's lows. And now we're breaking the downtrend line from the late 2013 highs. So as long as we're above that downtrend line, that dashed line, we want to be buying General Motors and shorting Tesla. So for every dollar we're long GM, we want to be short $1 of Tesla as long as we are above that downtrend line. Chart number 4, telecom. We talked about the strength in REITs. We talked about the strength in utilities, high dividend paying sectors. Telecom is no different. We're seeing AT&T and Verizon, 2 major components of this sector, making new 52-week highs over the last week. And I think that what we're seeing in the sector as a group continues to suggest that we're going higher. We are now breaking above a multi-year downtrend. Telecoms have been a serial underperformer for a long time, guys, but I think that this is now changing as interest rates globally collapse. Money is searching for yield. They're getting it in telecoms. And as long as we're above the downtrend line from the 2014 highs, we want to be long this spread, buying any and all dips in telecom and shorting S&Ps against it. Chart number 3, guys, one of my favorites right now is Amazon versus Walmart. Amazon has been the big winner here for the last 15 years. Not a secret. We all know that. But I think there's a lot of money to be making, a lot of money to be made in the unwind of this trade. Notice how last year we exceeded the upper end of this massive range, this uptrend channel, and from failed moves come fast moves in the opposite direction. I mean, it doesn't get cleaner than this, guys. I think going forward, Walmart will continue to outperform Amazon. As you guys who follow me for a while know that we've wanted to be shorting Amazon for several months, obviously very successfully. But I think that there's more to come here, particularly relative to Walmart. For every dollar we are long Walmart, we want to be short $1 of Amazon, all the way back down to the lower of these 2 trend lines. And ultimately, I think that we break. And I think there's a lot of money to be made. And I think this has just gotten started. So chart number two is not one that a lot of people expected. Energy gets a lot of a lot of negative press these days, particularly Exxon and other energy stocks. I mean, these have been crashing. There's really no doubt about it. But now this is changing. We've actually, as the stock market continues to make new lows, ExxonMobil relative to the market has not. We're making higher lows, higher highs. That's an uptrend, and we are breaking the downtrend channel from the 2014 highs. So the downtrend line from the 2014 highs. So Exxon's a name that we want to be buying, particularly relative to the overall market. So for every dollar long Exxon, we want to be shorting a dollar of the S&P 500. I think that this shift is a major one. This sentiment unwind can be extremely powerful, and I think it's got a long way to go in terms of upside. And finally, the best chart in the world, guys, I think is a Japanese yen. It doesn't get cleaner than this. Here we're looking at yen futures, putting in a textbook bottom over the last several years. We have yet to confirm to the upside. That neckline near the highs from the late 2014, has been hit 1, 2, 3, 4, 5 times. The more times that a level is tested, the higher the likelihood that it breaks. And I think we're heading a lot higher, probably towards 94 in yen futures. I think that's where we're headed. We want to be buyers of that breakout, and I think it's coming soon. So, again, we're offering you guys a major discount. I hope that you enjoyed the presentation. I hope you enjoyed the charts. You guys have given me a ton of great feedback, and I appreciate that. Just remember that with membership, you're getting a weekly multi-page letter, a monthly conference call for members only, as well as a video of that conference call for your archives in case you miss it, or maybe you just want to see it again. The chart book with over 300 annotated charts, I think it's great value, a great supplement to whatever work you're doing already. Just a great reference. If you want to see how energy looks, or see how financials are looking, or see how Japan looks, or how oil looks, you can always reference those charts. The members only forum, 24 access to myself. Don't forget that. Most importantly, a 30-day risk-free trial. If you don't like it, you get your money back, guys. I mean, just think about how much money you've lost in a given trade or in a series of trades. Imagine had you taken that money and just reinvested it in yourself in terms of education and access to a community. I think that we have a great community here at All Star Charts. Huge discount offer, only temporary, guys. It's not going to last long, but I wanted to give you guys a huge discount for the Super Bowl. We're offering $297 for the quarter. It's $297. It's less than $100 a month. I think it's a great deal. Less than $1,000 for the entire year. These are tremendous discounted prices, and you can go to allstarcharts.com/SuperBowl. We've gotten great feedback from members, and I would love to hear feedback from you. So at the very least, try the 30-day risk-free trial, see if it's for you, and just know from the bottom of my heart, I put a lot of work into this. This is my homework that you guys get to access, and I'd love to have you on board. There's no doubt about it. So thank you again for joining me today in the 50 best charts in the world. I hope you enjoyed it. I hope you got some value of it, and I hope to be hearing from you soon as we welcome you to the All Star Charts membership. Thanks again.